Welcome to the Stay Hungry podcast. Today, we are joined by Jeff Glick. Welcome.
Thanks a lot, Matthew. I really appreciate it.
Yes, sir. I brought you on the podcast because you are a seasoned CPA and a fractional CFO. I mean, you've done this for the last 20 years. You've really helped founders to scale and to raise capital. And you're the head of U.S. operations at Outsourced CFO. But to start things off, take us back to the younger you. What got you started as a CPA and in the whole CFO world?
So going back a number of years, we'll just call it that. I really didn't know what I wanted to do when I was going to college, and my parents didn't go to college. My grandparents didn't go to college. I just knew I got into a state university in New York, and I didn't know what I wanted to study. My mom said, "Why don't you become a CPA?" And I go, "Why?" Because my cousin Bobby is a CPA. He has a nice house in New Jersey.
There you go.
That was the extent of the thought process. That, you get a couple letters behind your name. My parents thought, college should be a trade school.
Interesting.
And I learned the trade of accountancy. So went there, had a lot of fun. And I had one job in New York City. I didn't like living in the city. Then I had another job in Westchester County, like in the suburbs. And then I just didn't like public accounting. I don't know if my latent ADD was kicking in, but it was a different world back then, very manual. And I did get my license. So I worked in public accounting 2 years to the day.
Wow, to the day. Okay.
I made sure I got my license. So I could always have those 3 letters behind my name.
Mm-hmm.
And then fortunately, I got a job at Merrill Lynch internal auditing in Stamford, Connecticut, in their real estate division. Then I got a job at Salomon Brothers, which is back in the day, that's the equivalent of Goldman Sachs.
Wow.
I was a cost accountant in their division that ran refineries. And I did one project for the right person. And I figured out how to hedge their risk every day because, one day it's oil, crude oil, next day it's gasoline as it goes through the refinery. And I put together this module on risk management, and then they put me on the trading floor to work with the traders on risk management of their inventory. So I did that for about a year or so. And then they said, "Okay, Jeff, you're a CPA. You went to internal auditing and you know how all of our operations work. We're going to make you a manager of mergers and acquisitions." So
Wow.
I said, okay. And I went out for 5 years around the country, took a few foreign trips to buy assets for them. Their goal was to be 100% vertically integrated. Oil wells, trucking companies, refineries, pipelines, convenience stores, so they could gather all of that margin all the way up. And that was really exciting, a lot of fun. But I was getting tired of it. We're having our first child. I didn't want to travel anymore. So they made me in charge of operations for precious metals and foreign exchange trading. So that was exciting. It was something new. And I was like 29 years old.
Wow.
And after that, they had this kind of this funky joint venture with the Russian Ministry of Finance at the time. And this is back in the Yeltsin-Gorbachev days and perestroika, bring down the wall and all that stuff. And we were selling probably 50% of the precious metals going into catalytic converters in the United States. So about 6-7 months later, I got a tap on my shoulder. Our joint venture partners, the Russians who were there, wanted to leave. And they had an out after 2 years. So they took their option and they took me along with them to be their CFO. So at age 30, I was a CFO of probably a $500 million company. And I was way over my skis. And we left and we had a checkbook and a lot of metal and some cash in the account. So we had no infrastructure, nothing, but we were trading with GM, Chrysler, Ford, Mitsubishi. So some of the biggest trading houses on Wall Street and some of the biggest mercantile exchanges in the world. So we had to put together all our infrastructure really quick. And so that was a great learning experience for me because I had to put everything together. So our trading partners will still do business with us. And we kind of, over the course of 16 years, we got up to about $2 billion in sales. So we had a lot going on. And I was, building staff, and I was responsible for everything, finance, administration, operations, everything but trading. And that means I was in charge of all the trade execution, and if we have enough water in the water bottles. So it was kind of and I did insurance, I did everything. I was responsible. I had a staff, but I was responsible.
I assume so. Right.
Right. And
It
so
sounds a little crazy because you said you were about like 30 when all this happened for the
yes,
CFO
yeah.
part.
And so I just, for some reason, they liked me and trusted me. But it really taught me how policies, procedures, internal controls, doing the right thing all the time. That there's no other way to do it except the right way. And plus, we also had a lot of compliance with the CFTC and our parent company, the
I
Russian
imagine.
Ministry of Finance.
Do you have tips for that? Because you went from a very small job relatively to this massive CFO like leadership role in a very short amount of time. Do you have tips for how you got to that point? Because that was what, in less than 10 years probably, that like time frame there?
I was 30, so yeah, it was
So it was a pretty fast jump like to scale up
quick.
like your job there.
I think, I was a nice guy. People trusted me. And if I didn't know something, I told the truth. I didn't fake it. And everything I did seemed to work out. And if it didn't work out, I didn't make the same mistake twice. And I was just fortunate that the team that was from Russia that was here in the States, maybe they didn't have anybody else to turn to. I don't know. But they saw what I did in those 6-7 months while I was in charge of their operations. And
Is working with Russia fairly different compared to here?
well, we were here in
Okay, so there's like working with you from Russia. Is that what you're
from
saying?
Russia, and we also
Gotcha.
had 4 or 5 people from Russia in our office.
Got you. Okay.
So but you just had to roll with the punches, do the right thing, be able to talk to our trading partners and say, hey, this is how we do things. How do you do things? And let's work together. But my benefit was it was a lot slower back then because there was no internet. So,
right. Less tech, less AI now.
And so this is in the early 90s. So if you were going to do something, it was okay that it took 2-3 weeks because that was fast.
Right.
Because if you believe it or not, we would build data centers in our office, and we would have to wait to get the air conditioner for that office. So
Really?
yeah, and
That's
so
funny.
I've gone through the whole spectrum of change in
So how have things changed for you personally then? Because you've seen how tech has changed things like completely, like your sector, right?
you just have to be able to learn what's going on and make that more efficient in what you do, and get the people to use those tools to make them better at what they do. Because I always told people, if you make me look better, I'll be nice to you.
Right.
And I'll give you the opportunity to grow. So if we become more efficient, more effective, and do a better job, we could really make a finance function into I wouldn't say a profit center, but we're a strategic asset of that company because
Right.
we need to tell people what's going on before it's too late. And if we're not on top of things, the whole thing could have a negative impact. So,
Exactly.
and I was very fortunate at a young age where I had the CFO of the company I worked for, Fibro Energy, which was part of Salomon Brothers. His attitude was, if you do the work, you do the talking. So everything I did for him, I presented myself. I was 25, 26 years old. I didn't know what the hell I was doing. But he taught me how to present, how to look people in the eyes, and make sure I knew the answers to the questions they were going to ask.
Wow.
Which
Very
was
great leader there.
right. And I basically, that was the start of my rapid rise, let's say. So everything worked out great. We grew the company. I was 20 minutes away from my family. I didn't have to work in New York City. It was great. And then Putin came along and kind of changed the whole world on me after
I
16 years.
imagine.
Yeah. So they wound us down and they were selling all the assets to oligopolies. So I was like in that whole historic area or
Wow.
era. And, then '08 came. So the whole world came into a recession. So, I lost the job of a lifetime. I lost a lot of money. My kids were about to go to college. So '08, my kids were going to college in 10 and 12. So we had a lot going on. And then I kind of started my own outsourced CFO group called Start You Up. And we did outsourced CFO and compliance for hedge funds, private equity, VCs, family offices, did a couple of SPACs, special purpose acquisition companies. So I did a lot in 15 years, owning my own firm. And then I kind of ventured into solar energy for a while and then some other stuff. And now I'm associated with outsourced CFO, where we help small, mid-sized businesses grow from the inside out,
Mhm.
making sure that their reporting is timely, accurate, consistent, tracks key metrics and benchmarks, and their reporting is strategic. Because a lot of first-time entrepreneurs or owners, I hate to say it, they don't know what they don't know.
Exactly.
And they're focused on, intellectual property, new products, sales, going to conventions, and growing their top line. And the boring stuff of accounting and infrastructure is sometimes not looked at until it's too late. And the McKinsey Institute came out with a report recently that 6 million businesses will be sold or available to be sold for a value of $10 trillion in the next 10 years as baby boomers are aging themselves out. And these people need to figure out, what are they going to do? That's the issue. And they need to make that investment in their financial infrastructure and make sure that they're bankable. Or it could be a family or a family business. Grandma, grandpa founded it. Brother and sister they took it over. They really enhanced it, and they have great lifestyles. It's a lifestyle business. Nice house, cars, pools, nice vacations. The kids have nice cars. They will go to private colleges, but there might not be enough money to spread amongst each of them has 3 kids. Now there's a lot of people who want that lifestyle day one. So that's something else to think about. How are you going to make more money now? And you need your accounting infrastructure for whatever you have to do more than track cash, accounts receivable, accounts payable. And if you have enough money to make payroll the next week.
I'm curious, question for you. If you have like a company, right? They have like an excellent founder, great team, but once that founder leaves, it goes to like crap. Is that like very common? You've seen that where they're like a great founder, like a terrible like trainer for like bringing like their work to the next person to like take over for them there?
Right. And that's, when I've been on both sides of the acquisition table,
Right.
and what you're really looking for a lot of times is something that's called franchise value.
Okay.
Can this business stand on its own 2 feet without the founder?
Exactly.
And a lot of the times they're not making the investment in bringing up people to be that second in command. Introduce your clients to them.
Hmm.
Introduce your vendors to other people. So if you get hit by the yellow school bus, it's not all over. And that takes time, and it's an investment. Because if you think your business is worth 10 times free cash flow, hypothetically,
Hmm.
well, if you don't have people to take over for you, you might lose 2, 3x in your valuation.
Right.
And
Because they're paying for both the people and the systems, the company, the supplier, the product.
everything.
I'm curious from your point of view, how can you go from like a company to like growing it for like the whole like value for like a funding deal?
Well, it's not that easy. It
Right.
sounds
Exactly.
easier than it is, because you have to create this image that you know what you're doing.
Hmm.
If they're going to retain you as the CEO, or it depends how much you're selling of your company. And, people invest in people. I think a lot of people lose track of that. What have you done? What's your track record? Do you have any exits? How much value have you made? If you've, if you've made other smaller investments or acquisitions within your industry, how did you do? Did that on a cash flow basis, is that costing you money, or are you adding to it? And that's what you really have to develop a process to keep track of these things. And it's easier if you do it from the start. It's not that expensive, but then you have these financial statements and reports that you could use to manage your business better. I use this example a lot when I speak. I asked a contractor once, well, what's your margin on each engagement? And he goes, I don't know. We have about a 50% margin. I go, okay. Well, how many are above 50? How many are below 50? How many are at 75? How many are at 25%? He goes, I'm not sure. I go, okay, well, if I was an investor, I want to make sure that those 25s, we're not doing them anymore. Because when we start adding in, overhead expenses, or maybe there's a loan out. So all that goes into, and maybe that 25%, those, a lot of them are sold by the same person, and they just want volume business. They'll just keep doing deals to get volume. That's how they'll make their money. Or maybe it's because of whoever that manager is of the operation, once it's going, they need more help to raise so they're more conscious of labor materials. Excuse me. So now, if you want to track labor and materials, you have to put in some process to track labor and materials. If
Right.
you just have this big warehouse and people are just pulling stuff off the shelves every time, you don't know where it's going. Is it going to an engagement? Is it going in someone's car? You don't know. And those are the type of things, when people do due diligence, they look for.
Do you have tips for that? Because you don't want to have one massive spreadsheet, right? You want to have some sort of like order to all this stuff. Do you have like your own like system for what you usually bring to like a company to help them to like sort things out for like, their
Well,
system?
yeah. So the first thing I would typically do is do something called like a cap analysis,
Uh huh.
or sell side due diligence. Figure out where you need to improve before you start the deal, because whoever's doing the due diligence is going to do that. So you could say, here are my problems. I know what they are already, but we're waiting to have the money to take care of it. So that shows you're a good manager and you're proactive, not reactive. That's one aspect. So it's like sell side due diligence. You're doing due diligence on yourself. So that's one aspect. The other aspect is to take a look at your employee contracts, your insurance, and all this other stuff. Because if you're going to raise a significant amount of money, they're going to ask all these questions. How long are your key employees tied up for? And what's their incentive to do a good job? Am I buying a company that doesn't have the correct amount of insurance? Now I'm at risk. And so if I'm at risk, well, guess what? The purchase price is going down. So
Right.
it's a process that takes time to develop. And once you realize the gaps you have, then you have to do something about it. So I tell people, you need at least 12 to 18 months prior
Really?
to. Well, what happens is if there's issues, it takes time, and you might not have the cash flow to do everything right away unless you go into the market and raise some money to take care of that. and that's part of the valuation. So that's a negative part of the valuation.
Do some people try, you think, to raise capital and funds maybe too fast? Maybe they should like waited to receive like more like funding for like an investor.
And so there's another aspect to this is their personal life.
Correct.
Maybe they don't want to work as hard anymore. Maybe they want to do something else. So saying too early, too late, it all depends.
That's fair. Yeah.
But having said that, they typically take care of things too late because they don't surround themselves with the right advisors who they trust. And those trusted advisors are going to tell them things they don't want to hear. Because in a lot of times, a first-time entrepreneur, they don't know what they don't know.
Right.
If you're a second generation business, you learn from the first generation. And you may not have learned what's being done now. So what was good 20 years ago when they set stuff up, you're still doing the same thing. And
Right.
you're not growing your internal capabilities.
I'm curious, you've noticed like, the last like 20 years, do you see lots of like patterns for like this always tends to happen with this company or this trend from like what you've seen like the last 20 years for you personally doing this line of work?
Every day is different
Fair enough.
because every company is different. They all have their personal issues. I mean, and a lot of times being that trusted advisor, you're also their shrink because they tell you everything. They tell you about this kid is great, but not up for it. This kid is really good. We want her in the business, but she wants nothing to do with it. She just wants to get cashed out.
Right.
And so there's a lot of this personal forth. And I have a friend, he and his wife, they do counseling for businesses that are going through this. It's very emotional. And, this is their baby. They've raised
Correct.
it. And, and if they can't figure it out, they might get nothing for their business and just close it, which is devastating that they work so hard. So, and, now things are different. There's a lot more money out there in private equity and VCs. A lot of younger people are becoming entrepreneurs via acquisition. I don't know if you heard that. Where
A little bit, yeah.
right. So they're saying, oh, I don't really know what I'm doing, but I went to MBA school. I know how to analyze a business. I'll buy that business on the cheap, and I'll give the manager or the owner an earn out so he or she can teach me how to run that business better. And because I'm younger, I have more technology, I have friends who can do this, this, and that, and that. I can create this and I'll fix this business. And then I'll use this as the centerpiece for a roll up, let's say.
Hmm.
So that's one thing that has definitely changed. Banking has changed dramatically. Now you just don't go to a bank. You can go to a private equity fund or a private banking. So
Right.
it's all different.
I'm curious about the whole value of like a company, which might be kind of like a tough question for you to answer, with like certain benchmarks. So, for example, your cash flow, like your value should be cash flow times X. Or do you have like certain like KPIs you try and follow for like your whole like valuation of the whole like company?
Most people like, a return on invested capital.
Right.
That's just cash flow.
Uh huh.
I put in X, what's it worth after I do my valuation? Or I've gotten, I put $1 million in. Over the years, I've received distributions or paid out distributions to my investors, and they've gotten back 50%, but I know my valuation is going to make that 4 times. And, and is it internal or did you hire a third party to do it? That's reputable.
Hmm.
So they can really see what the value is. So, and there's a quality of earnings now. They've always had that. And that's, you pay a firm to figure out what you're worth. And is there some funky accounting that you're not doing? Because a lot of small, mid-sized businesses, they don't use cap accounting.
Right.
They have cash accounting. And are you properly accounting for percentage of completion? Are you?
Interesting.
I mean, it's fairly anal because it's not cash. So
Right.
you need to do a bridge from your old method to your new method, and it might create other answers to the KPIs.
Well, part of it's probably guessing too, because they don't tell you all their data, right? They'll tell you some of it, but you're having to guess what they're actually doing over here or over here, right?
Yeah, and then so at some level, whoever's acquiring you, they might know more than you about the industry.
Right.
So they're not really looking at your books and records. They want to see your sales and revenues. And they want to see like how many clients you have. Are you building it? And what percentage of your revenues are recurring and what is new? And so what people want is a high, depending upon the industry, but a high percentage of recurring revenue, because that
Right.
is what is worth money. New is important, but what's most important is the lifespan of that revenue. And so you need to figure out how to keep track of that. And so you need to work with providers that can sell your business for you at the right time, at the right price, and to present it in such a way to attract money or investors or banks
Exactly.
or somebody knocking on your door who's going to acquire you. And
Mhm.
then hopefully you get the big exit.
Do you have tips for merging? Because if you have company A and company B, they have their own people, their own cultures, their own system, and you're trying to form one company from both of those, right? So where do you try and take from both of those to like one culture to combine there?
Well, it's just not big companies It's also
Right.
smaller companies. They all have these issues with culture.
Hmm.
Who's the lead? Somebody has to be the boss.
Correct.
So, and in theory, they should be discussing how we're going to do this the right way
In theory, right?
in theory. Or they might say, okay, Mary, you're the CEO. I'll be the senior vice president of our operations. And they go, okay, now Mary's the one who's making the decisions, the final decisions. Or maybe they'll have a board. And that's another way of doing it, where the board is asking the hard questions.
Right.
And having outside advisors and having governance is so important, because they're going to ask you the questions that should be asked at the right time if you have the right people. I mean, I've seen boards where they're a bunch of friends of the owners, and that's worthless, because they're either getting a check or they're getting a piece of the company.
Right.
So their interest is kind of muddled. It's hard to figure it out, but they need the right board to ask the hard questions. And then they're not merging, well, they shouldn't be merging without a plan, because that goes into the economics where, okay, company A does a much better job in building infrastructure. Company B does a better job at accounting, bookkeeping, and all that stuff. So let's kind of make one team responsible for something, the other team responsible for something else. Maybe. It also depends where they are. Are they in the same region? Or, do they have different technology? Is it better to use one or the other, or just scrap it and just now you have more resources to get a really good system that's going to
Right.
last and add value on this merged company? Because at the end of the day, a lot of these merged companies, the people who merged, they didn't get bought out. They just rolled their interest into this bit bigger.
I see.
And so,
Do you think it's always like a good idea? Because you can't back out after you merge, really. I mean, because you could try like legally to buy them out, but most mergers are kind of final, right?
depends, but most mergers, the hope is if they're private companies, the hope is that they're building more value, and the people who own it will do better in the long run. Because hopefully, if you're combining businesses that are in the same industry, they'll become more efficient, more effective. They'll have more leverage with vendors because they're buying more, and there won't be as much competition. So
Right.
you become less of a commodity and more of a product.
Exactly.
But
Do you see tech changing like mergers like in the next few years? Because AI could like look at all like the data for you to then like help with the whole like process, right?
it's not happening in a year. It's happening already.
Right. Right.
I mean, seriously, I had a lunch with a group that's putting together an AI package where a company downloads their financial statements, key contracts, and some other key documents, and puts it through the black box and says, this is what you're worth.
Wow.
And it comes out with nice reports and pictures and all that. So things are faster. Now, it's an indication of value. From there, now you have to go back and do the due diligence of it. But it's
Right.
happening already. They know what your business is worth versus what's going on in the industry. They know they could slice and dice your information and compare that, metric by metric to the industry. If the industry, because, there's a lot of private companies that report, or there's places where you can get that information, especially if you're dealing with an advisory firm. They have this information.
Right. But you probably want to still call you first, opposed to do like your own like research, because that's all like theory. Whereas you're like a human connection. You actually have been in this like company, in this like sector the last 20 years. You know what's like happening here.
Well, the whole idea is that we're able to do a better job for our clients
Right.
by bringing in these people if they do a good job. But we're still responsible, and we have to look at it. And it's the same issue where somebody would take 6 weeks to prepare a sell side, do a diligence report. Now it could take them 6 days. And so, you still need that knowledge of the industry to
Right.
it's just doing it quicker. Life is just a lot faster. Like back in the Stone Age, like I remember when fax machines came out, or if I was doing a deal, I had to go to the office, or they sent a messenger with copies to my house,
Wow.
or we had fax machines, or we had the first laptops that were the size of a suitcase, so big you couldn't put it into a carry-on. It's the world has changed.
Quite a bit. But I see as long as you have like a strong leader, like financially, then you'll be okay. I guess like last question for you. If someone wants to be like a strong leader in this like field, like a financial leader, can we think about like leaders in this sector, that one, but like just for like finances only, what can they do to grow, you think, in that space?
Grow the company, or
Well, meaning like if
grow
you're
it as a
like the
business.
financial, yeah, just straight like finances, like it's right, the leader of that part of it.
I found the best way to grow my knowledge is to grow my network. Is, somebody wants to sell me something, I used to have to invite them in for coffee. Now I can just go on Zoom, and I hear what they have to say, and I say, listen, I'm not going to buy from you today, but tell me what you have and what you do. Um, and grow as, your job as a CFO is to be part of the leadership team and be strategic, where marketing, sales, the a construction side of the business, you want to be their partner, because you say, what can I give you to make you look better? Because other than that, you're just doing numbers. You are not
Right.
being strategic. You want to sit down with the CEO and say, okay, this is what I think we need to do. That's why so many really good CFOs become the CEO, because they know the business from top to bottom. They've been in the weeds, depending on how long they've been at their company. But their people have been in the weeds, and they treat their people well. And their people saying, oh, if Jeff gets a promotion, then there's more work for me to do.
Right.
That's what I said before. Make me look better, and I'll drag you along with me. And
It
so,
sounds safer because some sales guy being at the president, he might be like a fast one, but like a CFO had like the whole like background knowledge of the whole like company for like the past few years there.
yeah, they have that enterprise value. They
Exactly.
know what's going on. And, because you have to tell senior management things that are going to happen.
Hmm.
You know that given the track record of the last 6 weeks, 6 months, or whatever you guys are looking at, this is going to happen. Or, oh, wow, this really worked out. We're selling this product, and because of our pricing, it's really doing well. And because now we're selling more and we could buy more cheaper, our margins are better. And that's what they want to hear. And so now we can make the sell side look better. We can make the manufacturing look better. If you don't go out and speak to these people, all you are is a bunch of number crunches and not a valued, trusted advisor. And that's what I always tried to be. I didn't really like it, the nuts and bolts of the accounting. I was more strategic in nature. And, because I'd say, okay, what's your problem? Where do you want to go? And what information don't you have?
Right.
And if we can't get that information because of just the way things are done, we need, if it's that important strategically, then we need to change the way we do things. And that's
Wow.
that's a management call. But if no one's asking, you're not doing your job as part of the C-suite. You're not an accountant. You're a CFO, and there's a difference.
Dang. Well, you have been fantastic, brought lots of value to all of us here. If people want to find you online, where can they go to?
Jeffrey Glick on LinkedIn or Jeffrey at OCFO.
All right. Well, go follow
Easier
him.
to find me on LinkedIn, or they can email me. Either way.
Okay, sweet. Well, go follow him on LinkedIn, you guys. Thank you all for tuning in. And until next time, stay hungry.
Take care. Thanks, Matthew.